Special voice joining us now to make sense of all that's happening in global markets. Are the bears back, and how long are they going to be around? Madhav Dhar is joining us, veteran investor, needs no introduction, managing partner, GTI Capital Group. Makes sense for us, this correction in the US market that we're seeing. You know, one term that I heard being thrown around quite a bit was the fear of peak profits. Seemed a bit like peak oil. But what would you say? How would you describe the sell-off that we've seen?
No, I think it's just, it's actually very classical in the sense that you have had rising interest rates and a rising stock market for some time, and you get to a tipping point where rates start to bite, and it tends to happen at a time when the market's extended, profits have been very good, and people start worrying what the future will hold, both with potentially slowing growth and competing higher rates. And so I don't think it's anything unusual. What is unusual is just that you haven't had it in a long time, and people start extrapolating extremely low volatility, and it's the reassertion of an old-fashioned cycle which we haven't seen in 10 years, which is moving out of deflation into potentially higher rates, higher inflation, higher wages, which for the economy is a good thing, but it's not a great thing for liquidity. And as we all know, growth wins in the long term, but liquidity wins in the short term. And that's what's happening around the world, and that's what's happening in India.
So the correction in US, Madhav, is it likely to be similar to what we've seen in February earlier this year? And, from that point, the market sort of made lows and rallied on. Or do you think this is going to be bigger?
Yeah, probably. No, I'm not sure it's going to be bigger. I think it may get a little bigger than what we've had. My own gut feeling is that we have another big leg up. This reminds me very much of the 93-94 cycle, the 98 cycle, where after prolonged rise in the global economy, led as usual by the US stock market, the weak animals, the weak countries start falling first. And we've seen the exact same thing, that Turkey currency has corrected 50%. Countries with deficits, whether it's India or even Italy, have started to get damaged. Leadership narrows to just tech, and eventually everything gets hit. But that's not necessarily the end of cycle, and I don't think this market, which is now very extended, 10 years in both the economic cycle and the stock market, is quite done yet. I know it's a bit of a dangerous prediction, but my sense is we have one more leg up, simply because growth is still strong and accelerating, if anything. We can debate whether it's at its peak, but certainly this earnings season has been very good in the US. The yield curve, which is an important indicator, is not yet flat, or certainly not inverted, which is usually a sign of trouble. And importantly, credit spreads still haven't started rising in the US. So my best guess is a recession is 2 years out in the US, and if the recession is 2 years out, the stock market peak is probably 12 or 18 months out.
Okay, so you're saying the market may overshoot on the downside, so the correction could be a little bigger than February, but then you're saying we have another one last hurrah, right? One last big move higher, to fresh highs.
I think so.
Okay.
I think so. I think I think the preconditions of a serious US recession don't seem to be there, and it's very hard to have a serious bear market without the prospects of a US recession. So to me, the world is as simple as that. But every time interest rates go from zero to where they are, you're going to get some serious dislocations. And frankly, we've had very few, and volatility has been extraordinarily low. So this may seem a surprise and quite scary for people who are not used to it, but this is very normal stuff. We just haven't seen it in a while in a one-way bull market over the last 3 or 4 years.
Madhav, so the other big variable, global variable, is oil. Do you have any strong views there, where oil is headed over the next year or so, and the relationship
well, I have a strong view on the first part. Yeah, I have a strong view on the first question, and then not a strong view on the second question. The first strong view is I don't think it's a great global factor. I think it's utterly overrated. I think it's very important for small oil-producing countries. It's very important for small oil-consuming countries. It's not remotely important for global growth. In fact, oil prices are usually an indicator of growth rather than a predictor of growth. So oil prices are high because the global economy has done very well. So oil really becomes a negative factor when you have a massive oil shock. When prices go up without demand going up, which is what we had in 73, which is what we had in 79, that's when you get a negative impact on the economy, where the economy becomes a price taker of an artificial price. That's not good for the system. When the price of oil is simply going high because the economy is very strong, I don't think it's a material factor. Yes, it matters for India's deficit and certainly matters for what happens in the Middle East, but doesn't matter much to what happens in China and Europe and the US and Japan and the main drivers of growth. So I think it's overrated as a factor.
Well, when you talk about oil prices, you can't really forget what kind of impact it has on the Indian markets. We've seen that sort of respite come in the past couple of days. Brent has gone back to 75, 76. But the Indian markets don't seem enthused at all.
No, because there are other things happening in the Indian market. Yes, I think it's certainly a bigger factor in India than it's in the United States. But I don't think that's what is really driving the Indian market. You have a major credit crunch, and we can get into what the problems are. And that's the biggest factor is the S&P 500 and what's happening to the US. That's the single biggest factor for India. The second biggest factor is what has happened to the banking system and the credit and the more recent credit crunch. I would say a distant third factor is oil, certainly in the way I analyze it. So that's the way I see it. I think besides the global factor, there are 2 or 3 negative factors in India and not a single positive factor, which is why the Indian market is down more than average, about the same with emerging markets, which is why the currency has taken such a hit, because they have no real positive developments to offset some of it. The banking reform is going slowly, GST is taking its time. Privatizations of Air India and everything else got shelved. So where is the reform momentum that otherwise you're just a boat drifting in the ocean? Oil prices go up and you get whipped around. There is no other current that's taking you the other way. I would bet you that suppose we were a year ago and GST was solved and some simple straightforward thing, demonetization had not happened, Air India had been privatized, there were other candidates, we had worked through the banking system, the banking bad loan system a little faster, and then oil hit us, I don't think it would have been as big a factor.
Tell us a little more about what your thoughts are with regards to what's happening with the credit crunch. When you're talking about the NBFCs, the liquidity crunch, which they're probably facing, NPAs from the banking space, are we staring at maybe something worse in the coming months, maybe even emerging from real estate?
Possibly. I don't think, the good news and the bad news is it's been underway for some time. It's not the most recent credit crunch and ILFS and some issues with what we've heard about the other banks is a slight negative surprise. But this is something that has already been in the system. The state banks have underperformed. We know what's going on. So just the fact it's been addressed is a good thing. The fact it's been addressed slowly is not such a good thing. And I think the biggest thing, at the risk of getting philosophical, is that we have liquidity, and the banking system is the lifeblood of any economy. When the lifeblood of any major economy is more than half the banking system is state-controlled and state-directed, and there are misallocation of resources, you're going to go from one crisis to the other. And we have to get past that. You have to step up and privatize some of these institutions, however blasphemous that sounds. We are at that stage where we have to do it. We don't at all question that VSNL, that the private sector took over the public sector and telecom, and the world changed completely. That we accept. We didn't 20 years ago, but we do now. 10 years later, we accept that privatization of not privatization, but private entry of airlines has completely transformed air travel for the better in every aspect. We don't question that. But somehow we question the privatization of State Bank of India. Why not? And we keep going from one crunch to the other, and you have an interesting dichotomous system that you have oligopolistic license for the big private banks, and they can make monopoly profits forever, which is fantastic if you're owner of these stocks, and the other half of the banking system is a complete mess. And we don't find this, dissonant, and that has to be addressed. Otherwise, this will keep happening every 5-6 years.
Madhav, just leave us with a blueprint roadmap for markets here in India. Would you say we've kind of put in the low somewhere around here, maybe a little lower than here, or there is a risk of a serious slip?
I think so. I think so. Yeah, I have no blueprint, but my operating assumption we are close to a bottom. The currency plus markets have corrected. Depending what stocks or index you're looking at, somewhere between 20 and 30%. Economy is still fine and accelerating, if anything. Margins are still low, valuations still reasonable. So India is frankly in a different cycle. We're in an early cycle where the US is in a late cycle. So yeah, I feel that this was expected, and I'm not even sure it's overdone yet, but I think some bad news, both global and local, is getting into prices and the currency. And I'd be a buyer somewhere here, yes. And I think we get another big leg up.
Well, year to date, the Indian markets are flattish, but the mid-cap and the small-cap indices, they have lost between 15% to around 20%, making the bottom-up investment approach rather challenging and interesting. Joining me today on the show is founder and managing partner at Pabrai Investment Funds, Mr. Monish Pabrai. Thanks so much, Monish, for coming down and speaking to us here at CNBC TV 18. Well, let's start off. There's so much of pessimism, so many headwinds we're talking about, from rising crude oil prices to slowing global growth concerns. What are you doing as of now? What would you tell our viewers out there? Bury your head in the sand or go out there and deploy some money?
Well, Nigel, first of all, always a pleasure to hang out with you, and congratulations on becoming a new dad.
Thanks so much.
And you look pretty good for a guy who doesn't sleep at night.
Thanks so much.
Well, I think the thing is that, Ben Graham, one of his 3 core edicts that Buffett talks about is that the market is here to serve us, not to instruct us.
Right.
And so we should never be trying to kind of look for rationality in market levels or market prices.
Okay.
What we have to do as investors is effectively forget the market, but look at individual businesses.
Yeah.
When they're being offered at bargain basement prices, we buy, and when they're being sold at ridiculously high prices, we sell.
Yeah.
And that's pretty much it. And we don't particularly care about what's happening with Brent or what's happening with growth or what's happening with an NBFC. All of those are in the noise range. We really don't care about those things.
Oh, that's quite interesting, because there's been so much of noise and so much of headwinds that we have been talking about. Simple point, are you deploying money out of your total size of money that you're investing? I think you manage around $800 million approximately. How much of that is allocated to India? And are you buying, most importantly?
In fact, we bought today. We bought some sizable chunks, and we're buying every day. And I think out of the 800, about half, roughly about half is in India. And that number has been inching upwards for the last several years.
Okay, so you're definitely buying into this correction, deploying money into the Indian markets as well.
Yeah, and again, like I said, I don't particularly care about corrections and such. I think in general, when we have situations like we have currently, a number of businesses go on sale.
Okay.
And as long as an investor can understand the businesses, it's within his or her circle of competence, and can buy them well below what they're worth, that's the name of the game. You should be buying at that point and ignore the noise.
Well, you're sitting away in California, but you relate, to your roots, to India, and you relate the markets to Mahabharat. I believe that you derive some inspiration from Arjun focusing on the target. Is that something you're looking at?
That's right. So
explain that to us.
Well, we all know the story in the Mahabharata about Arjun and Dronacharya, and he has this test where he has to shoot the eye of the fish, looking at the reflection in the pool of water. We all know that. And when Arjun is asked by Dronacharya, what do you see? He says, I see only the center of the center of the eye of the fish. And Dronacharya says, fire at will. And of course, he shoots the eye out. And so the direct analogy there is when we are looking at a specific business and we're looking at the future prospects of a business, we really shouldn't deviate or take our focus away from that into anything else that's going on.
Okay.
So I'll give you a very, very simple example. So when we had the unfortunate incidents of 9/11, when the Twin Towers went down and so on, U.S. markets imploded after that. One particular company in the U.S. called Stewart Enterprises also went down, like everything else.
Right.
Stewart Enterprises buries dead people. Did the prospects of Stewart Enterprises suddenly deteriorate after 9/11? If people were concerned that there were going to be more airplanes flying into more towers, as morbid as it sounds, their business would have boomed.
Yeah.
And so there was no rational reason. I mean, United Airlines should have gone down.
Yeah.
American Airlines should have gone down. Stewart Enterprises should have gone up.
Right.
It didn't go up. It went down as well. And so markets gyrate between fear and greed, and they have a lot of irrationality. Our job as investors is not to try to give reason to the irrationality. It's to take advantage of irrationality.
Okay. In India, it's perceived that real estate was a safe investment. Every Indian out there, they want to go out and they own their own home. And that's why real estate has been a play. Now, for one, you have been fairly positive on the real estate space. Just looking by your holdings, you have a large chunk in Suntech Realty, in Kolte Patil as well, you have a large chunk, and also in Repco Home Finance. So how do you see the real estate space playing out in India? Is it an opportunity with the kind of correction we have seen on a lot of these real estate stocks, as well as some of these, home lenders?
Yeah, I think Pabrai funds will do extremely well and make a lot of hay off our real estate bets.
Yeah.
And the reason is very simple, that the market or investors really don't understand how to properly value real estate companies.
Okay.
So the way a real estate company ought to be valued is, and it's not that hard, most real estate companies are pretty transparent about their holdings, about their debt.
Yeah.
And so you can come up with some kind of market pricing on the holdings. You can subtract the debt and you get an asset value. You can even discount that in case prices drop and so on. Yeah. So that gives you what I would call the liquidation value of a given real estate company.
Okay.
Most of these companies that I'm invested in trade at a substantial discount to liquidation.
Okay.
Which means if they shut down their business today and sold their assets, we'd get a multiple of what the stock trades at, even in today's market. But that's not the way to value the business. That's one aspect of the business.
Okay.
The more important aspect of the business is these companies are factories. And the factories are not physical plants, they're virtual plants.
Okay.
And the factories have the ability to keep making deals, keep cranking out more finished product, and continue on. And so just like with Maruti, when we value Maruti, we look at the next 10 or 15 years of revenues and growth Maruti. We have the same thing we need to do with real estate companies.
Yeah.
We have to look at what are they possibly able to do in the next 10 or 15 years.
Yeah.
And so one of the things that's happened in real estate is that because of RERA, GST, demonetization, all of these things, 80 to 90% of real estate companies are either gone or on life support, and they will be gone. So if I'm participating in an industry where 9 out of 10 of my competitors are gone, that's a phenomenal place to be.
Yeah.
And so I think that the companies that we have, we bought them well below liquidation, but that's not really where the game's at. The game is about what they do in the next 10 or 20 years.
All right.
And if I look at a place like Mumbai, because specifically I'm interested in real estate in Mumbai, it is one of the only places in the world where people live in very expensive housing, which is terrible. The housing stock in this city is terrible. And in fact, if I take a 30-year or 50-year view, almost the entire city will be torn down and rebuilt. And the torn down and rebuilding that's going to happen, we're down to about 20 players.
Okay.
And so that, just think about the size of that.
Yeah.
And it's very hard for new entrants. The other thing, if you go on Wikipedia and look at most populated cities in the world, let's say in 2050, number one on that list is Mumbai. And I know we think that too many people here today. Yeah. In 2050, we're looking at north of 50 million.
So clearly you're bullish on the real estate space. You also made a reference to Maruti. So I wanted to take both those 2 points forward.
Sure.
One is, what's your view on the automobile space in India? Are you investing out there? It's a known fact that Pabrai Investments has a large chunk out of your total funds in Fiat.
Yeah.
So in terms of the auto space, what's your view? Are you bullish on the auto space in India? And also the second part, what about Repco Home Finance? That's another company where you have a large chunk. Real estate you're bullish on, but some of these home finance lenders, they're going to be, there's a lot of competition out there. You have liquidity that's drying up as well. So give us your take on both these two.
Yeah, so actually, as far as the auto industry goes, I hate the auto industry. I think it's a terrible industry.
But you have a big chunk in Fiat.
Yeah, so in 2012 is when we first invested in Fiat. And from 2012 till now, Fiat has delivered, it's about 6 or 7x now. At the peak, it was about 8 or 9x.
Okay.
So it's done really well, but we bought it basically at 1 times 2018 earnings. So in 2012, we were buying at 1 time 2018 earnings, and that actually came to pass.
Okay.
And so we were buying a company with 150 billion in revenue at a 5 billion market cap. I paid 1/30th of revenue. So one simple thing you can look up for Maruti after the show, look at the market cap, I think it's something like $20 billion, and look at the revenue of the company. It's the complete opposite of Fiat. So Maruti is very dominant, phenomenal business.
Yeah.
Investing is not about identifying great assets.
Okay.
That's only one part of the equation. We have to identify great assets at great prices. And to me, Maruti is a great asset, but it is nowhere near a great price.
Okay, all right. And what about Repco Home Finance, the housing finance space on the whole?
So, we're not into stock tips, Nigel.
Yeah.
But I would just say that I think Repco is a very different DNA than the India Bulls or Divan Housing and let's say the high testosterone NBFCs. And also they serve a market where they have almost no competition. So they're in a ticket size of like 10 lakhs, 20 lakhs. They're into rural areas or tier 2, tier 3, tier 4 towns. And so a lot of similarities to Group Finance.
Right.
And so so I don't think you can paint all the housing finance companies, all the NBFCs with the same brush. They're all different.
Yeah.
This is an interesting business. It serves a demographic that is very underserved. And so that's what interested me.
All right. It's been a pleasure talking to you, Mr. Pabrai. Thanks so much for coming down to our studio. Always good to speak to you. Well, on that note, we'll wrap up on the show. Thanks so much for watching. That's Mr. Monish Pabrai telling us he's definitely investing in the Indian markets. He's definitely bullish going ahead as well. And he says it's not the time to bury your head in the sand.